How do sovereign debt crises affect global inflation? Have you ever wondered how a country's financial troubles can ripple through the entire world economy? Sovereign debt crises can have a profound impact on global inflation, and understanding this connection is essential. At its core, a sovereign debt crisis happens when a government struggles to pay back what it owes. This situation can lead to various inflationary pressures. One major effect is currency depreciation. When a country faces a debt crisis, its currency often loses value compared to stronger currencies like the United States dollar. A weaker currency makes imports more expensive, which can drive up prices for everyday goods. This imported inflation can affect not just the struggling country but also its trading partners, contributing to global inflation. Another important factor is the rise in borrowing costs. Investors become wary and demand higher interest rates to compensate for the increased risk of lending to a government in trouble. As a result, governments might tighten their budgets to calm the markets. However, if they choose to print more money to cover their debts, this can lead to even higher inflation. Central banks, which are responsible for managing a country's monetary policy, face significant challenges during these crises. They may need to raise interest rates to combat inflation. But doing so can increase the cost of servicing existing debt, putting more strain on the government's finances. This creates a tricky situation where central banks struggle to control inflation effectively. Interestingly, inflation can also reduce the real value of a country's fixed-rate debt. This means that governments might tolerate higher inflation to make their debt more manageable. However, this can lead to a loss of credibility in their monetary policy, causing inflation expectations to rise. As a result, nominal interest rates may increase, further fueling inflation. Sovereign debt crises can also have global spillover effects. When one country faces financial turmoil, it can lead to shifts in capital flows and investor behavior. For instance, if investors pull their money out of riskier sovereign debt, they may flock to safer assets like United States Treasury bonds. This can impact global interest rates and exchange rates, complicating efforts for countries to coordinate their economic policies. Moreover, many emerging and developing nations borrow in United States dollars. When inflation rises in the United States, it can increase global borrowing costs. While inflation in the United States may reduce the real value of dollar-denominated debt, a stronger dollar can raise debt servicing costs for these countries, adding more inflationary pressure. In practical terms, sovereign debt crises create a challenging environment for managing inflation. Policymakers must find a balance between maintaining fiscal sustainability and ensuring credible monetary policy. Global coordination becomes crucial to address cross-border inflation effects and financial stability risks. Overall, sovereign debt crises can raise inflation both directly and indirectly through various channels. Understanding these dynamics is vital for navigating the complexities of global inflation management.